Good morning and happy Monday. Today, it's just me. Nationalist Paradise is MIA today. Apparently, he had some prior engagements. So appreciate you guys hopping on, joining me this morning. Want to talk about the markets, see where we're going, where we were last week, and what we can expect this week kind of heading into it. So let's begin. Let's dive in. Last week, super high volatility, although there wasn't much of a movement. You say it's a high volatility week. We started at 6.74 and ended at 6.71. Yeah, it was intraday volatility that really was pretty wild last week. If you go back and look at the charts last week, 4 of the 5 days, the mortgage-backed security market moved intraday, meaning within the same day, more than 25 basis points, 4 out of 5 days last week. So we had a lot of mornings that would start off really, really well. And by the afternoon, we would lose everything we had gained and potentially end up a little bit worse than where we started. So overall, pretty flat week for mortgage rates in general, but extremely volatile. Just intraday, it makes our job obviously a little bit difficult. You know, it's one of those things that when we start the day off good, we want to see those gains build. Like we start off and we're 20 basis points better in mortgage-backed security pricing. We're like, do we lock it now or do we try and hold and see if this turns into another day of gains and another day of gains? And last week was a little bit frustrating because we would start off good and end flat or negative, and it was just one of those kind of weeks. So let's dive into it. What actually happened last week? Last week's economic news. Just so you know, I'm going to be looking off to the side because the screen in front of me I can't read it. It's too far away. But last week was a big data week. We had a lot of news come out and we had really good inflation data come out, although it was very much in line with expectations. It's exactly what the market was expecting, but it was really good data. Consumer price index, previous month was 0.4% CPI headline number, increase of 0.4%. For the month of July, came in at 0.1%. Massive drop off, although again, it was in line with expectations. Year over year dropped from 3.5% to 3.4%. And the core, when you strip out food and energy, which is the super volatile things the Fed can't control. And you may ask that question, why is there even a measurement that strips out food and energy? And it's a great question to ask. The reason for it is monetary policy. What the Fed does can't control food and energy prices. They're controlled by global things, not necessarily what happens inside our country. That's why it's a separate measurement, excluding food and energy. That dropped from 2.6 to 2.5%, but again, in line with expectations. So it was exactly what the market was expecting. Initial jobless claims came in about exactly where we were thinking, came in at 209,000. They were expecting 202,000. And then Thursday, we got the producer price index. That came in completely flat, 0 rise. Now that one actually beat expectations. We were expecting 0.2% increase. It came in flat. But again, you look at, the year over year numbers, 5.5% previously dropped all the way down to 4.7, beat expectations, was expecting 4.9. So last week we got a lot of good data in. Why didn't the markets actually react to it? And the other really big piece of data we got in was retail sales, but I'm going to kind of bring that up last. Why didn't the markets react to it? Markets really didn't react to it because all eyes are in focus on this conflict we have in Iran. And it's the same thing we talk about every single week. The data's here. But right now, the data just doesn't matter. What matters is insecurity for the future of the market, and conflict is insecurity. Retail sales was a huge, huge miss. Previous month was 0.2% increase, expecting a 0.1% increase, and it dropped off with a 0.6% negative reading on retail sales. There's a lot of talk about this. Some of it is very, very actual, that Amazon's Prime Day, if you think how one company can impact the economics of our country so much, this big drop off is, a lot of it is attributed to Amazon moving their Prime Day from July to June this year. And July's numbers fell off substantially, and we think that the expectations were still some bleed over from that. So let's talk about news coming up this week. I wish I had a cricket noise to play right here, because on this chart, there's basically no market moving news. You see a couple red bars at the bottom, global manufacturing PMI. Those don't really move the markets the way we want, unless there would be something massively that changes there. There's two things, however, that are going to be market moving things this week, and they're not on this list, ironically. Number one is today is the expiration of the 60-day ceasefire in our conflict with Iran, and that is a big deal. Again, if we don't enter, what is this, version 582 of the ceasefire? If we don't enter a version 583, we go back to battling each other, we could see things degrade pretty quickly. Right now, oil's sitting at about $83 a barrel. It's actually performing way better than we would expect this far into the conflict. And you say, well, why is that? Well, the Strait of Hormuz being, limited right now, it's not necessarily a full stop. There's still oil getting through, but the pipelines to the Red Sea have definitely increased production. So right now, we're only running about a 5.5 million barrel a day deficit, when expectations, if the Strait of Hormuz is closed, could be significantly more than that. But 5.5 million barrels is a lot of oil. Like, if you think about this is a daily drop off, 5.5 million barrels per day as a deficit right now. And you say, well, that's a lot of barrels of oil. But understand that every barrel of oil creates about 19 to 20 gallons of gasoline. So you're talking over 100 million gallons of gasoline as a deficit every single day right now. Oil prices remaining at 83 is actually pretty impressive. I would expect them to be higher than this. So this week, all eyes are going to be on the ceasefire. If we enter another one, what goes on with that? That could rock our markets really, really, really poorly if there's not something that's extended out. The other thing that's not on this list, on Wednesday, we're going to get the Fed meeting minutes. And this is super important, and the markets are going to dive into this. We know at the last Fed meeting, there were dissenters, people that wanted Fed members that wanted to raise the interest rate. We know the outcome of the meeting. The meeting minutes is what actually happened in the meeting. So the investors are going to get a very deep dive today of who said what everyone's opinions really were. And that's something that absolutely could move markets on Wednesday. And so I'm talking about two things that I think we could move the markets in the wrong direction. And it's really kind of a scary thing, because right now we are sitting right on kind of the cliff edge of mortgage-backed securities. Right now we're sitting just under the 471 on the 10-year treasury, 470-ish. That's 471 level has held many times. And if we break significantly above 471, there's no stopping on the 10-year treasury. There's no support levels until we hit 480. That would mean the mortgage-backed security market would likely drop off about another 45 basis points to the downside, worse rates, if we get news that isn't favorable this week. And we're sitting right on that edge. So it's something, if you're a loan originator and you've got deals coming in, have these conversations with your clients, because we're on the edge of it right now. Let's go to the next slide and kind of talk about what was the next one. Fed futures. Pretty much what we were looking at, the same as the last meeting, although the CPI coming in, or the PPI coming in lower, did drop this just a little bit. There's only a 30% chance right now markets are pricing in of a rate hike at the September meeting. Now only a 50%, I believe that was in the 60s last week, for an October rate hike. And I agree with the sentiment we talked about last week. I think we just need to get the rate hike over with. I personally hope they do it at the September meeting. I think it would give our markets a bit of footing. But yeah, we're definitely looking at a rate hike this year. I personally hope it happens sooner rather than later. Let's hit the next slide up. Mortgage rates sitting about the 6.75 mark ish. And this is kind of, we talked about this last week, but if you draw a line from the bottom of that chart in March where we hit 6% to about where we're at today, you can kind of see all those bottom lines just start to line up. And I think we're below where that trend line would be. So right now, if you're floating loans, we need to be cautious. I do think we have the ability to get worse a lot easier than we do to get better. So as we head into this week, it's probably going to be a shorter update because Nash isn't here to kind of talk and he talks a lot. I love him, but he talks a lot. But yeah, here's the thing, guys. This week, the market is going to move very much on technicals and what comes out of this conflict with Iran. That's going to be the important thing. So all eyes today on the ceasefire, probably into tomorrow. Ceasefire wrapping up. Do we enter another one? Do we just start bombing the hell out of each other again? That's going to really impact the oil and impact us. And then Wednesday, Fed meeting minutes. Outside of that, I don't see anything else that's really going to move markets this week. So we're kind of on edge, like I had said. If you're a loan originator watching this and you've got loans floating, be very cautious with it. I think Rob Piccolo last week made such a great point. If you're waiting until the high volatility days and you're like, oh my gosh, we entered into the ceasefire today, we're going to gain 20 basis points. Understand that the lenders are not passing 20 basis points along to you. They're starting the day off on these high volatility days, Fed meeting minute day on Wednesday, padding 10, 15 basis points in there in case it would get worse. So understand that you're not playing a game where you're going to win against the lender. You're not going to win this big thing. Be very cautious floating. I do think we could potentially see that 480 on the 10-year treasury if we get bad news this week. And that would be kind of a gut shot once again to it, put us in a really tough spot. But hey, here's the thing. We're all in this boat together. Rates are rising for everyone together. And there's still business being done. So the question is are you going to hide with your head in the sand and act like this market's got the best of you and start to adopt that negativity mindset? Are we going to go out there and make the business come to us? I was listening to a colleague of mine, Ben Bell, talk this morning. There's people out there that are waiting for the phones to ring. And those people are going to be crushed by people like me and Ben that are making the phones ring. So get out there, have some positivity in the face of all of it, and let's go out and have a great week. Appreciate you guys. Take care.